Gonna bring in Shaun Wooley and Dan Canzone. What's up, Shaun?
How's it going, Dan?
What's up, everybody?
Morning, guys. How are you?
Good.
Morning, Dan.
Yes, sir. It is morning. All right. Well, we've got Shaun Wooley, Bay Equity mortgage lender, and we've got Dan Canzone, who's an independent insurance broker with Goosehead Insurance Company. All three of us have moved here to Idaho from out of state. And so we all have a similar idea what people are looking for, which we'll probably talk about a little bit today. So here we are. We are going to talk about Ada County market stats today. Dan, you live in Ada County, don't you?
I do.
And Shaun and I both live in Ada County. Again, to reiterate, not together, but we both live in
separate homes.
Shaun said that in the last video he did. He said, well, we live together, sort of, but that's not what he meant.
Definitely not bunk beds. Definitely not bunk beds.
I'm on the other side of the town from you guys. I wanted to keep my distance.
Stay safe.
So real quick, I'm gonna put up everybody's information. Where did it go? Oh, it didn't pop up. Background. Okay. I'm still getting used to this stuff. Sorry, guys. All right.
You're better than I am. I couldn't figure it out.
It's pretty tricky, man. There's a lot to it on this dashboard here. And then Shaun Wooley, there he is.
Wow, I had hair.
714.
Yeah.
I know. I'm just playing.
Can't get rid of it. Otherwise, my mom won't be able to call me. So.
Okay. Well, anyway, thanks for joining me today, guys. We're going to try and do this as smoothly as possible. Obviously, it's still pretty new, but I think we're enjoying it and happy to have Dan in here today. So let me bring in some market stats and we'll talk a little bit about what's been going on this year over last year, over the year before that. This one's 2022. I need to bring it up. Sorry, I thought I was prepared. January 2023, Ada County.
Can't believe it's March already.
I know, right? Let's make that a little bit bigger. Does that look good?
Are these month to month, Dan, or are these like year to year kind of thing?
So these are year over year, just January to January. So I have right here, I've got this year and last year, and then this one I've got last year and the year prior. So we can look at like closed sales in January 2021 as 607 and 676 last year, and then 454 this year. So we're down 30% or so, 32.8%. Obviously, here in Ada County in Southwest Idaho, it's cold, right? So we do have a little bit of a selling season. While selling doesn't stop in the winter months, it does generally slow down. 2 years ago, notwithstanding, we charged pretty hard right through the cold season then.
Especially based on where rates were 2 years ago.
Yeah. I mean, that too. All these little things have an effect, obviously. We'll look at median sales price in 2021, 449.9 up to 540, so up 20% the year after, and then now we're down almost 10%. So our inventory is going up, as you see here. Inventory is actually up 165% over the year prior. So prices are going to go down when inventory goes up. We are looking at 3 times the amount of inventory that we had over the year prior. So 1.7 months. Let's see, 0.3 months in 2021. This is when houses were selling in hours. You rarely saw a house sit. Didn't matter what it was, right? It could have been
unseen.
Say it again.
Sight unseen. People buying through Facebook
many,
apps.
many homes were being sight unseen. I sold quite a few just with video camera recordings and walkthroughs and stuff like that. Dan, do you think that your business is seeing a similar changes over the years, or what are you seeing?
Yeah, absolutely. My business is all based around realtors and mortgage brokers. So when they're down, I'm down.
Yeah.
So
And
absolutely.
the majority of your business, would you say that it's just homeowners insurance lines or auto lines, or do they all kind of stick together? How does that work?
I would say it's probably 70-30, 70% homeowners, 30% the bundle.
Auto
You try to do everything together for discount purposes, but
right.
it's not always the situation. So it's probably 60-70% on the home side.
Okay. Do you know could you tell us just out of hand what the average premium is that people pay for homeowners? And I guess it's different in different areas, right? Because of the different values, median values for homes and stuff.
Yeah, I mean, every area is going to be different, and then it's based off of age as well, size of the home. So the older the home, the more expensive the premium is going to be. So I would say on average, you're probably looking at about $1,000 a year.
Okay, well, and really, when you think about it, that's not too bad, right? I mean, if your house falls down and you can, I guess it depends on what the. Oh man, I'm drawing a blank on the money that you pay up front to get the
deductible.
The deductible, yeah.
Yeah, I mean, things are different out here, right? I mean, it's Idaho. There's not a lot of hazards, more or less. Like California is a completely different story.
Right. Termite insurance and
zones.
fire insurance.
Oh yeah. I mean, you have fire issues all around you in California. Out here, not so much. So there's not a lot of risk for these carriers. So, on average, I'm looking out here at $1,000 deductible. It's not very much.
Right.
Premiums, it could be more, it could be less. If it's a brand new home, it's going to be pretty cheap. Usually, but on average, about $1,000 premium with $1,000 deductible.
That's not too bad.
No.
I mean, when you think about what you can get back for it, obviously if you have a disaster or something, and obviously I know that there's things that if it's a slow leak that goes over months as opposed to a flood that happens in a day, I mean, the ramifications are different, but generally speaking, $1,000 for a year and $1,000 deductibles, not too awfully bad if you need to use your homeowner's insurance.
Yeah,
I think most
hundreds of thousands of dollars that they could potentially be paying out.
Right. Yeah. So get your homeowner's insurance. Obviously, you have to have it if you have a mortgage, right, Shaun?
But, yeah, you definitely have to have it.
If you pay cash, you don't necessarily have to get it, which could really bite you in the butt. So back to the stats here. So it looks like we're down. We're also down on. So we're down on all the important ones, and we're up on days on market, which is. Obviously, we're getting more inventory. We're coming out of the selling season, so that should start to go down a little bit. But the rates don't help either, right, Shaun? I mean, what are we?
Yeah, I mean, rates always, they seem to be fluctuating pretty dramatically from week to week or day to day. But even on like literally within a day, we've seen reprices for the negative and reprices for the positive. But like when you look at the numbers of like homes at like medium home price and stuff like that, I feel like it's kind of skewed if we look at that, because that just means more homes that were sold that were more expensive. I mean, and let's face it, there's a lot of $1 million properties that are still selling, right? Maybe not as quickly as they used to, but that kind of skews the market. I don't know if anyone's building a home for much less than 400,000 at this point, right?
No. And if you look here, the median sales price right now, or at least
it's 500 something, right?
23. Well, it's gone down. It was 5.6, 540, and it's gone down to 490.
So that means less people are buying more expensive homes. In essence, those are the homes that are closing, right?
Maybe.
But in terms of like days on market, right? Like obviously people are, payment sensitive or down payment sensitive, right? Like, but when inventory is up, you find more people willing to, I don't know, concede something to the buyer, right? Whether that be
Oh, for sure.
cost or a 2-1 buy down or a 1-0 buy down or a mix of both.
For sure.
I mean,
And days on market's much more difficult to pinpoint why, right?
Yeah,
There's
I mean,
everything.
how many of those are $1 million properties? Well, maybe there's less people looking for those, right?
Right. Or it could just be, it's a total beater that even investors are going, oh, we're not going to look at that one. Or, I mean, there's a million variables that affect days on market. Pending sales, we've got 975. Well, on February 8th, they had 975 pending sales, 27% under the previous year, which was 1346. Man, it seemed like in 21 and 22, obviously the pandemic time, the market was going crazy, which is really, really funny because we thought at the very beginning of that, oh my gosh, business is just going to stop. Everything's going to just stop. Right. And then we had a month of, this is my numbers just out of my head. We had a month of the sky is falling. And then many people realized many things. Oh my gosh, I live in LA or wherever, sorry, LA. And I don't want to live here anymore because it's horrible here. They're keeping us locked inside, et cetera, et cetera. So let's go find some place where it's a little more free or whatever. People were leaving for all sorts of reasons, but I think that we've met a lot of people that, that's why they moved. And
does it make sense to compare to before the pandemic even? To see
like in 2019?
Yeah.
That would be interesting. I mean, we could go in and we could log me out.
I mean, because in the mortgage market, like the last 2 years, it's hard to. It's kind of the anomaly, right? So,
just to see it, let's look at 2018.
I mean, will we ever see 2 3/4 rates again? I mean, is that even a realistic thing?
No.
So,
I mean, it was manufactured. Let's face it, right? That's how it all happened, and that's what drove the market down. So the Fed was easing and flooding it, and making it easy to borrow money to keep the economy moving. But now they're not, right? They're tightening.
Well, now they have to combat the inflation
by Fed rate. And they're making it harder to borrow and less money in the supply, less money changing hands. And so, things are going to slow down. I mean, eventually inflation is going to come down. Eventually. It just depends on how painful it has to get in the meantime before they stop raising rates, right? And when inflation comes down, then it makes more sense for people to get back into the bond market. So
I think too, what we've seen, and you can probably attest to this, Shaun, is that people have also gotten a little more comfortable with, we were in this sort of fantasy honeymoon period where these rates were, like Dan said, just crazy, crazy low, historically low. And then they shot up to, we saw 4 and then 5 and then 6. And it was like, oh man, this is kind of crazy. But I think that it's kind of been hovering for quite a few months and people are just sort of getting used to it too. Like, okay, all right, this is where it's going to be. We're not going to go back down to 2.5 again, or, even 3, or maybe even 4. So let's go ahead and do this. Let's, as Dan, what was the phrase you used earlier?
What was it? Date the
marry the house,
marry the home.
Yeah. So you realize that, hey, look, if we can't wait to buy, we got to buy and wait. We got to get in, start putting equity in our pocket, and then as soon as the rate gets a little more agreeable, we'll just refi. We'll call Shaun and we'll say, hey, look, what can you do? Maybe you want cash out or whatever, but. So look at this. If you look at these numbers from 2017 and 18, $240,000 in this area. I moved here you moved here in August 2017, Shaun?
October, yeah. But 17.
And we moved here in the last day of June in 2018. And I can attest to this. These prices have gone from 279.9 to, 487. Everything's doubled. It seems like everything's doubled. we're seeing a little bit of a correction now. We're seeing a lot of homes that were put on the market high, thinking that we could still get those 2021 and 2022 prices, are slowly coming back down to our new reality. And who knows how long that'll be for. But
let's go back to the days on the market one, though. I think because of the insane rates that we saw, that drove the prices up like crazy. But what's the average time on market back then versus what it is now?
Well, you might be surprised here. It was this year we're looking at 71. Last year we're looking at 36, and then it was 41 in 2018. So homes were selling faster than they are now, but not nearly as fast as they were. Well, almost to what they were last year. And then 2021 was 19. I mean, homes were selling in minutes, right? They were going on the market. People were getting 10 offers, and then they were making their decision and going pending in 1 or 2, 3 days. Obviously, this average is offset by the outliers. Homes that were in bad shape, or I don't know why these homes were sitting. Obviously, also a lot of these numbers are skewed by homes that are new construction and sit on the market.
Yeah, no.
From the time before they even dig the foundation, right?
And builders have been pulling back for a year.
They go online, and so those numbers, when they end up selling, are 160 to 300 days. Mm-hmm. So that's what skews this too.
And builders have been pulling back for about a year.
Yeah, this time they were having a hard time keeping up.
Well, I mean,
just something that came to mind right now. I've been seeing a lot of talk about, like, I know with me, I'm a veteran, so I get the benefit of the rural when when rates drop. I can do that without a whole lot of hassle and refi really easily. Is FHA and the what is the other one?
USDA.
Yeah.
Are they coming up with programs to help with doing these refis? I saw something about no appraisals needed anymore or something.
Well, that's a streamline for an FHA. I mean, if for a refinance and EARLs you have an EARL situation, but they don't have appraisals obviously either. But USDA is a little bit different altogether. But Fannie and Freddie are updating some of their guidelines for other collateral means to verify the data. So not necessarily everyone's going to be stuck with possibly a full appraisal kind of thing, but it really depends on the information that goes into the system and how that system reads it and tells you at that point on that AUS or DU approval or LP approval, whether or not you need an appraisal. Is it necessary or not? If it's cash out, like, man, I think I've only had one appraisal waiver on a cash out deal versus if it was rate and term and it had a good equity position, that it just doesn't need an appraisal. There's enough data recorded that says there's little risk. It's scoring like, let's say, a 2.5 on a risk score or below kind of thing. So it's just nature of the report and how it processes the information.
What is EARL? Is it IRL?
No, it's interest rate reduction refinance loan.
IRRRL.
Yeah, it's EARL. Yeah.
It basically is no documentation. You just, as long as it's, what is it, a point and a half?
Report, making sure you don't have mortgage rates. It's basically you have to have a benefit to the veteran, right? And
it's like a 0.5% reduction or something like that.
Yeah. So in the on the EARL too, like if you have a VA loan, you're stuck with 210 days worth of seasoning, basically because veterans were being taken advantage of and they were being like loan churning. So they were just flipping people from cash out refinance to an EARL and then cash out refinance to an EARL or to an ARM to a fixed to an ARM to a fixed. And you at 100% still refinancing and then the loan's going up and maybe the loan's going up faster than the value of the home, right? It's kind of predatory. So
yeah,
that's why they stick this 210-day thing. So
okay, my thought behind my question on that is just with the interest rates as high as they are and the market where it's at, if people were to buy with these rates that they have right now, I mean they're what, pushing 8% now?
No. I mean, or if we want to talk VA, the highest VA loan I locked in the last probably 4 months was 7.25.
Okay.
And
So
it was decent. That was good credit, 0 down kind of thing.
right.
So can
And
you
so they
tell
can
us?
refinance technically right now and have benefit, but I have to wait the 210 days before we can touch it. So
So
but
with
on the
that,
30-year fix, 20% down, good credit, that kind of thing, we're looking at high sixes still.
okay.
Yeah, not bad. Not bad. Not
So
great.
my thought behind the question though is like, so they get into this rate that's 6.75, right?
Mm-hmm.
And then as the market shifts, are things becoming easier for the lender or the borrower to be able to refinance that loan and drop that rate pretty quickly?
No, there's not
No?
like any they're loosening guidelines or something like that. No.
Okay.
You're still full qualifying Fannie Freddie. It's all full documentation. It's not. Yeah, there's
Do you think
no
they'll come out with
abbreviated
anything to help?
process.
Do you think they would ever come out with anything that might be able to help them do that?
I mean, it's really up to them, but what they should do is figure out how to adjust the loan level pricing adjustments for second homes, investment properties, all this other nonsense that they keep on adding to basically the pricing mix that we get, forces us to give a certain rate kind of thing. So that would be helpful. That would help people and it would help interest rates. But I don't see them changing like guidelines or moving like a Fannie Freddie to like a FHA Streamline or Earl where, it's a credit pull. There's no income verification. It's that process won't happen with Fannie and Freddie. So, no, I don't see that coming. But I know when the market back in 2008, 2009, like that whole thing happened, and then like right around 11, what was it, 2010 or 2011? They came. 2012 was 2012, like the HARP programs, where people were like upside down. Like the equity position in most homes is pretty good across the United States. So I don't think we're going to run into the issue of like being upside down. You know what I mean?
So that kind of means that we're not going to have this. It's a lot of people are saying, "Oh, we're going to have a crash like last time," and that's exactly why we're not going to have a crash like the last time.
Well, yeah, because people qualified. They weren't, for lack of making $12 an hour, buying one home with 0% down because they could fog up a mirror, paying for all intents and purposes someone else to falsify assets or whatever.
Well, and it's easy to walk away
and then closing the loan and then opening up a HELOC for X, Y, and Z, and then going and buying a BMW. So
yeah.
I mean the Big Short.
The
Big Short was a great movie. Put it that way.
That was a great movie.
And that's basically what was happening. So,
well,
if you haven't watched it, go watch it if you want to get a good idea of 2006 and 2008.
That movie is spot on to what was happening.
Yeah.
So,
and I wasn't in the mortgage industry. I only got licensed in 2012, so it wasn't me. I didn't do those loans.
Wasn't me.
All I know is regulation, government control. So,
I was actually in the mortgage industry during that time.
Yeah.
You were.
And I got out because it didn't sit right with me. I didn't like it.
Yeah, there was a lot of shady stuff going on, and that's partially that's why we had the crash.
Yeah.
Obviously there was a lot of predatory stuff going on, like from the movie that you're talking about and all that. But people were happy to walk away from something that they didn't have any skin in the game. Oh, I got a free loan. Oh, I got a free house, basically because the loan was free and I didn't have to put myself out there and
I'm just paying for points. Yeah.
When I saw these pop-up communities coming up in like South Carolina and I think even Florida, there were these communities that were just popping up, the homes being built, nobody occupying them. Yeah, it was crazy. And that stuff is talked about in The Big Short.
Do you guys remember when like so many houses were sitting and the lawns were all going brown? So they had companies that would come in and paint lawns so that they still looked green, so that the property values around them didn't plummet too.
I worked for an REO company briefly, and I had to evict people from homes as they were, like cash for keys back in the day.
Yeah. Don't destroy the house. We'll give you $5,000.
Yeah.
Please
You
don't
need to be
destroy
out
the
by
house.
X, Y, and Z, and then you have to change the locks and then kick out all their stuff to the curb if they leave it. Yeah.
So
Hard to
I
sleep at night
have,
with that one.
I have here a house.
Oh, Sugarberry.
That is a house.
Sugarberry.
Man. Look at that
Sugarberry is
garage.
a neat house. Let's go over the numbers real quick and who owns the listing. Piers Lamb and Max Corsi of Homes of Idaho. These guys have this incredible property listed. Let me see what I can show here. So it came on at 4.6 late last year, and then it slowly dropped, not a whole lot, but down to 4.1. Speaking of which, the house that we went over a couple weeks ago or a week ago, the one up on Croft, 6.7 million. I did a video on it under contract. I can't wait to see what they got for it. It was a beautiful property. Anyway, just over an acre, 5-bed, 6-bath, 6,465 square feet. It was built in 21. Have a look at this. Let's see if that.
So these are probably the original owners.
And this is not $1,000 premium insurance policy.
No. Talk to us about that while I fix this. Talk to us about what that would cost.
If I was to guess, I would probably say about $5,000 a year. Just guessing, taking a shot in the dark.
But that's not horrible either when you think about the cost of the house, and their taxes are going to be, or at least have been. Let's see.
It's probably not as bad as you think.
No, the assessed value is half that. Oh, you have to look that up for me, Shaun. I don't have it.
It's 4.1.
Oh, here it is. I'm sorry, $2,215 last year. So maybe if they pay $4 million, and if it assesses much higher, then maybe 4,000. Just think, what were you paying on your
California house?
Yeah, in a California house, $8,000, and it was worth $700,000.
6,500 a year, something like that.
Yeah, crazy. So
this house insured in California would probably be more around the 20,000 plus mark.
Ooh.
If you can even insure it, depending on where, like a house this size, that's going to have to be in the hills somewhere, and it's going to be almost
layers to it.
So then there's fire hazard.
Oh yeah,
nothing like that.
That's not a standard track zone right there.
So you weren't here, Dan. Sorry, but we did one that was $155 million last week. And the tax rate, it was in Beverly Hills. The tax rate was like what, 1.4 million a year? Shaun?
It was $600. It was about $650,000 a year annual taxes. Yeah.
Wow.
Yeah, I saw that house that you did. And I would say that house was almost impossible to get insurance on.
Yeah.
So somebody that buys a house like that is probably going to self-insure it. If you were able to find a policy, it's probably in the $100,000 range.
That's one thing that kills me about these super expensive homes. Isn't just the price of the home. That home isn't just $155 million. You've got, you saw the landscaping on that. That's $500,000 a year keeping that up, right? Then you've got the insurance if you can get it. Then you've got your taxes and all these other things. Man,
so
not to mention the cost of all the parties that you would have at that house.
So the levy rate's 0.44.
0.44.
But
so
at 4.19, 4.19, just without the homeowner's exemption, because at that point, what does it really matter? Is about $18,000 a year.
So the homeowner's exemption, for anybody who doesn't know, the homeowner's exemption here is $125,000 for the home that you own and occupy. You can remove $125,000 from your property tax basis as long as your house is worth more than $125,000. So,
and to give you an idea, obviously we know that there's a difference, and sometimes so we qualify off of purchase price minus homeowner exemption and levy rate, right? But the person that's in this home has it assessed. It's assessed for 2.439, right?
Mm-hmm.
So that's what they're paying that 0.44% off of, which is why their taxes is so much different than the two. But eventually, and like we've seen it too, properties do increase in value. as homes are sold around you. So when you get reassessed, it's possible that you're paying more and you're paying more. So the lender is thinking, I have to kind of hedge against this increase in value. And so why we want to qualify someone off a little bit higher of a number than what the person is paying at this point in time in that home. So yeah.
That's good info. And we don't have, California has Prop 13, which locks you in at your rate plus no more than 2% per year, I believe.
Yeah. And it's, even California, you just, for all intents and purposes, the tax rate's there. And if there's any special assessments, which sometimes is what gets you, and it's not the actual rate, but it's purchase price times that plus the assessments divided by 12. I mean, it's easy.
Yeah. So this house, I don't know if you can see through.
It's gorgeous though.
Go ahead, guys. Sorry.
No, this house is gorgeous though.
Look at that backyard.
The Nike symbol.
Yeah, look through the windows. You can see that there's a training facility sort of thing back there. Looks like there's turf. We'll get back there, but it looks like there's turf.
Yeah.
So these wrap over islands are becoming quite in vogue right now. The house that we were just talking about, this for 6.7 million on Croft, had that. We showed another house recently that had this same sort of wrap over granite or I guess it's marble, and then the one on Croft had lights in it, so it lit up. It was really, really cool.
Yeah, it's backlit.
That's called a waterfall edge, right?
Waterfall edge. Right, you taught me something. I liked wrap over.
Oh, I love the lights underneath.
Yeah.
My question is, where are the outlets on the island? That's what I need.
Right there, right between those two drawers, right here. You see them?
Because I'll be making stuff, right?
Well, I'll be charging my phones anyway.
Yeah, at least something. Margarita machine.
That's right. Speaking of which, there's one right here.
Butler pantry.
Yeah.
Yeah. Or just a huge, yeah.
Or a second kitchen.
Yeah, right. Right. Let's get to the backyard, man.
Yeah. I mean, it's just a nice house.
Yeah.
The glass doors, though, kind of freak me. The glass railings kind of freak me out as a parent, but and like for fingerprints and stuff like that, that would But
yeah.
I guess you have other issues when you.
Oh, okay, because you need this.
Wow. This was you need. That's
what you need. Right there.
Wow.
Look at that. 3 sets. Man, you're doing a lot of laundry. I don't know. Lights, darks, sheets.
Gym clothes.
Yeah, right. That is the epitome of extravagance, right? That's pretty cool. Yeah. Oh, wait a minute. There's like you can see the guy taking the picture in the.
It's looks like a side of a submarine.
Right. So this looks like a game room. Game room has a half kitchen sort of bar thing in it. That's
kitchenette.
Cool.
Oh, they're Packers fans.
You got these heaters out here. That's nice.
Can't be a Packers and a Niners fan.
There it is.
Look at that.
It's all turf. That's like a third of an acre right there.
It's like a full-size soccer net.
Yeah, it's like literally an abbreviated or soccer field.
That's you go out and you kick some goals, you shoot some baskets, you jump in the pool, then you go wash.
Yeah,
and wash the whole neighborhood's clothes.
You keep going because I like this next part. I've seen this. I saved this one in my favorites. Of course, score. No, keep going. Right here.
Oh, look at that.
With the doors and
roll-up doors like the beer guys and Star.
Mm-hmm. I mean, you're comparing it to a bar, but yeah. Yes, they have roll-up doors too. But yeah, I mean, that's just that facility is just like so cool to me. Like if I had that as a kid playing baseball or soccer, like that would have been awesome.
Here's the drone. You see the drone operator down here.
Wonder if a professional athlete owned this house or something. I mean, this is ridiculous.
I was wondering. I don't know, but would you would you hold all of your kids' sports team practices at your house?
I would.
Yeah.
I would even offer free training. I mean, I do have a degree in exercise physiology, but but that would be like a hub. Like you have everything. Like, I don't know what you would.
You really don't. You really don't ever have to leave that house. So
I have to get groceries, but they can be delivered.
Yeah, you can have those delivered. Totally. Look at the garage. That I guess one of those garages is actually the gym. And then one of them,
you would think, right?
And then one of them's you got a 6-car garage there. I didn't look at the numbers on that, but
and where is this in location? I mean, I know.
Man, this is off of. We'll look at it. I'll bring up the map, but it's off of Chinden. It's over by the temple.
Okay.
Let's see.
I feel like I need to go play the Super Lotto and
Just
hope that I win so I can buy this house. This is crazy.
Right here. Sugarberry. Let's go. Minus. Let's look for this. Yeah, here's Temple. So this is Fred Meyer right here, Chinden and Linder.
I know where that is.
Yeah. So this is just right behind that. There's some really, really nice homes in there.
Yeah.
And they're almost sort of unassuming. Like you can tell that they're big and they're nice, but when you're driving past them and you can see between the properties, you see that the yards are enormous, obviously, like with this one.
Yeah. But it's only like an acre, right?
1.02. But yeah, for most people, an acre's that's a big piece of land. Yeah.
My lot,
inch of it.
Yeah. My lot back home, I looked it up the other day when I was in California, was 5,400 square feet.
Yeah, mine was probably the same, and the house was like 1,600 square feet. Let's see, it was what street did we live on?
I had an 1,800 square foot house, and then the lot tripled.
Well, that was my address when I was.
Yeah, my last house was an eighth of an acre.
Eighth. Yeah. Yeah, basically sidewalks for backyard.
We had a little bit of yard in the front, like because we were on the golf course right here. It was actually out here. This doesn't show. This is like the garages and.
What golf course is that? Is that Willow?
Meadowlark.
Oh, Meadowlark. I played there. I probably hit your house a few times too.
Probably.
I'm not very good. Yes.
That's right. It was 20722. Can't remember the name of my street. Anyway, it doesn't matter.
Yeah.
I'll have that for next time so we can talk about how small our lots were there. I'm at 13,900 something feet here. So it's like 3 times what I had there. Yeah. So much better. So anyway, I've kept you guys for 40 minutes. I appreciate the insight and the information. Let me see if we can put your info back up here again. If anybody's even still looking. We can put some music on. Put some music on here.
For anyone looking to buy that house, I'd be happy to insure it for them.
There we go. And I would be happy to sell it to you. So give me a call. You can get a loan through Shaun. And I think that's it. I saw that, Shaun.
Why'd you put your logo in my corner? Come on,
there you go. I could probably move it around. I have no idea. All right.